Yes, sir.
Is there any, you change that, because it looks like there's clearly a lot of information based on that example.
Yeah.
That you based off of that 10-day
Yeah.
criteria.
Yeah.
Is there any point where you tighten that up or you increase that?
Yeah. So I use the 10-day high. So the question for the folks at home, I actually remember, and I stopped pointing at the screen. Look at me learning right in front of you on video. So the vertical blue line means I am stalking. What does the vertical blue line mean?
Stalking.
I'm stalking. And I want to go long on this one because of reasons. So if I want to go long, the next thing I draw is a red line. And let's say that it terminated in some kind of candle on any time frame. But let's just use the swing frame, because I'm going to argue that if you want to be a good trader, understand the swing trade and cherry pick the easy ones, because that's easier than doing hard work. So do it easy. So let's say this was a 5-day down, 5 lower lows, and then there was some, that was the 5th day. And then I hope tomorrow that it opens inside that range and then takes out yesterday's high plus a nickel, and I have a mechanical entry on a swing trade. I can do that as a swing trader. I will do that as a swing trader. As a day trader, if this thing opens inside yesterday's range in an orderly fashion, so it's inside yesterday's range, and then starts moving, and the whole market is moving, and the sector that it's in is better than the market, and it's better than the sector, that is a low-risk entry right there. On the mechanical, I might be able to enter it here with a half a position or a day trading size position, because now my risk might be 20 cents, whereas on the swing trade it might be $2. I can be 10 times as large intraday as I am overnight because of the problem with the gap. So intraday, I might be able to manage a 20-cent stop. And so I could buy 10 times the position of the swing trade. So don't buy 10, just buy 5. And then when it comes through this line, you can say, well, the swing trade just confirmed that this thing is moving in the direction of some reasonable profit target to the upside based on the swing trade. Now, your specific question was, Ken, you mentioned the 10-day high. Are there other things that we might use to estimate a reasonable upward move for day trading purposes? Yes. Yes, there are. Yesterday's high, the 10-day high, the 30-day high. It could be, if it opened here, the range stat, the range statistic, which is the average range of the last 30 days plus or minus 1 standard deviation. That is, now I'm going to check your learning. What is the definition of the range stat?
It's the average win.
Maximum reasonable intraday move. So the range stat is the maximum reasonable intraday move. What is the range stat? The maximum reasonable intraday move. It's measured by looking at the average of the last 30 days of range. So we compute the ranges of the last 30 days. That's high minus low gives you the range. Not the true range, because that includes overnight gaps, and all I care about is the intraday move. So I take the range of the last 30 days, and then I rank that by the max down to the min. I find the average from that max to min, and then I compute the standard deviation of that. And then that gives me plus or minus 1 standard deviation, and then there is some maximum and some minimum. Now, because of math, it turns out that 1/3 of the price ranges of the last 30 days are plus or minus 1 standard deviation. So 1/3 and 1/3. So 2/3 of the time, it falls between, today's range is going to be the average range plus or minus 1 standard deviation. 2/3 of the time it's going to fall in that range. And about 1/6 of the time, and 1/6 of the time, because of math. What that means is, in the last 30 days, 5 out of 6 times, it did not get farther than a range stat intraday. Only 1 time out of 6 in the last 30 days did it move more than a range stat. So as a way to establish the maximum reasonable intraday move, I calculate the last 30 days of range, find the average, add 1 standard deviation, and we define that as the range stat. So when this thing opens, here's the open, and it starts to go up, my job is to say, well, there's the low of the day plus a range stat. It could go to here today, and we cannot be surprised if it does that. So that's a way to measure the potential upside. I might look at the hump of the dragon or the hump of the RL10 and say, the last time on a swing trade, on this path to pain, it did this, and I can draw that line across and say, well, if it gets this far and starts to fail, I'm not surprised. So my initial for swing trading is I just like to use the 10-day high just to put a mark on the wall that can be broadly applied to all of the candidates. And that's the number that I use to estimate the maximum pain, because that makes sense. It's 2 weeks worth of look back. That's 2 5-day weeks. And swing traders go from 2 to 15 days. That's right in the middle. So a 10-day high is within recent memory. And I know from other research from the swing trade, the channeling and the overreaction systems, when they pull back from the 10-day a certain distance and start to reverse, that's a low-risk idea on a swing trade. So that's all this is. I'm using that same information to compute reward to risk, and then I pick an object to be my reasonable upside move for that time frame. Now, if I was looking at monthly and weekly charts, I could look for the hump of the dragon. I could take a look at Z1, Z2, Z3 excursions. I could compute average ranges and say, in the last, and look at the law of streaks. In the streaks, what is the length of the ATR moves that they're making, and use some multiple of that. So I can use Renko boxes to start figuring out the length of trend and the size of trend and all that. All I'm looking for is something that gives me a reason to justify that as an upside target that doesn't require me to suspend all rational thought. So it's going to be based on multiples of price or some derivative of price like that. Now, once I know that 10-day high, the next thing I'm going to do is look for all the places where it has hesitated before and mark those off as checkpoints on the way. If it gets through here, then it's more confirmation that it's going back to what I thought was the 10-day high. If it fails there, it failed there before. I'm not allowed to be surprised. Engage 2-hour battle drill and execute based on how much I'm willing to give back. Routine. I expect that to happen. Maybe 1 out of 10 goes as far as 2R. That means 9 times out of 10, I'm getting less than the full 2R scoop. My average win is 0.6. My average loss is 0.2. That's 3 to 1. I define that as letting my winners run and cutting my losers short. But Ken, it's only 0.6 and 0.2. Well, there's a psychological factor in here. I'm just fighting for fractions, so, I can afford to be efficient, and I can reduce waste. The other part of this is, so the same target on 2 different days with 2 different trade frames, and they both had 5 days down. Today, it had a really tiny little doji that was 20 cents. It's only 20 cents of a little doji. And this day, the range was, it was one of these, and so it was $2. Same symbol, same pattern, same 10-day high, and I risk $400 per trade of risk capital is one bullet. That's one chip for me. Now, if I take 400 divided by 2, and I use my execution risk as my position sizing algorithm, then because of the random circumstances that cause the range to be that big, I could buy 200 shares, check or hold. $400 divided by $2 per share of risk gives me 200 shares. If I use the size of my execution risk over here, 2,000 shares. 400 divided by 0.2, I could have 2,000 shares. That's the maximum position size that I could have, which says if this execution price hits and it kicks me out, that's the most that I could have if I could exit right on that price with no slippage and no commission. And then I just took the maximum loss that I'm willing to take without losing my mind. That is a bad idea. Don't do that. So I just say, look, now, what if I was using, instead of just 5-day down in a mechanical entry, maybe I was using frog boxes or a z-score or some a quarter of an ATR or some whatever. So my position sizing might be somewhere on this scale, anywhere from 200 to 2,000 on any given day. And I will tell you, for me, I'm just reporting what I feel. If I'm trading a thing with 200 shares, and I have $2 of risk to manage, and I'm trading 2,000 shares with 20 cents over it, that is a different trade. I am different in the way I manage that trade. I look at it differently. It gets my attention. I worry about stuff. And so in order to abstract that, I might just say something like, for day trading, at the start of the week, whatever the frog box is, the frog box equals the standard deviation of the 30-day range. It's usually a wide number. I can usually get, my execution risk is usually about 0.3 of a frog box. So I would say take 2 frog boxes and make that your standard unit of risk for position sizing for that symbol for that week. So if it was $2, then that week I'm always buying 200 shares of that thing. And sometimes the execution risk will be small, and sometimes the execution risk might be enormous. But what I'm really looking for are ways to find those kinds of reducing the execution risk by finding critical states. That's why I like red doji, green go, or Z3 pinch, or an owl pattern where this thing has been horrible and turned, and now my ability to put that stop in very tight is here. And now my entry is here, and it should go all the way back there, and I got lots of possible moves to the upside, but a very small minimum manageable risk box. That's how I manufacture small average losses and no skin in the game. I'm not emotional. Of course it's going to fail a lot. The risk was small, and I've identified something where a critical state, whereas if it does this and then fails big that way, I could make 0.6 or 0.8 or 1.0 on the way down, and it pays for that altogether. A 1R win, not even the 2 that I'm aiming for, but a 1R win pays for 5 of these other excursions, these 0.2 losses. A 0.6 win pays for 3 of them. So I'm playing lots of hands at a small enough level of risk that I can execute my strategies and rules and habits of mind routinely. I'm going to play 10,000 hands of this thing, not put it all on this one, and this is going to be the one. I got to get that one exactly right, and everything in the universe has to work correctly. I want to be able to make money on a day when I'm at the C- of, I wasn't especially good today, and okay, so I took home a sandwich. I didn't get to bring home a full meal. I get to bring home a sandwich. I want to make money on days when I'm not particularly brilliant or lucky or whatever, and then sometimes I get big ones. Good things happen to bad people. All that means was that on the ones where I got where I aimed for 2 and I was going to settle for 0.6 and be happy, or no lose plus dinner for 2, I'm already happy. It got up to 2R and beyond. When I'm totaling up my little scores for my histogram, that's just a 2R win. It could have been an 8R win. It's a 2R win in my histogram when I'm computing what's really going on. Because what I know is that 8R came from the other higher time frames doing their things, had nothing to do with me down at the noise level. It was those guys just decided to go. And if they go 3 legs, they're going to activate that next higher time frame, 2 levels up. And he starts coming in. This thing could just go. So I'm open to that possibility. Don't count on it. There's nothing in the information in my time frame that tells me anything about the probability of that happening. Nothing in the moment of decision. You cannot detect that difference in the tactical time frame. All you can do is establish those broader time ladders of confirming, it's still confirming, it's still going up, it didn't fail where it failed, it's still going up. That's a vote to the upside. So as long as you know what those price ladders are, and you see where those guys have acted before and they didn't, that's information. You can make some decisions about what to do with swing trading and all that based on those price ladders. But what I'm interested in the day trading is bringing those ones that are closest to my area of operations. What are those price levels that tell me the other guys are starting to vote higher or lower? Takes out yesterday's high. Hey, yesterday it could only get to the high, and then it failed some distance to the close. Oh, today it took out yesterday's high. That means today somebody with money is buying it at a price higher than they could even get to yesterday. That's a vote upward based on a higher time frame. Takes out the 10-day high, breaks through the hump of the dragon. All of those are breaking through former levels of resistance. The hardest thing for me to ever figure out is, hey, if this thing gets to an all-time high and is going, well, now what? I don't know. I just buy it and put a trailing stop, and as soon as I can get my risk out, off it goes. That's what I do. But everything else is engineering in between the hump of the dragon and the belly of the dragon, and calibrating moves and statistics and lots of repetitions at small levels of risk so I can trade a lot. Lots of hands of poker. Because if you've got a positive expectancy system, you want to play it as many times as you can at the lowest level of risk that enables you to meet your financial goals for that system. That's my approach to position sizing and operations. I want to be an R factory. I want to be a brick-making machine that takes standard stuff, makes a brick, stacks it, makes a brick. Pay attention to the little bricks that I'm making, stack them over there. When the day is done, wash my hands, bow, stack the bricks, move the bricks to the work site, build the wall, improve the castle, pave a road, build a statue, whatever we use bricks for, but they are standard bricks in the same way each and every time. That's what I do. So you need to know that, because that informs the way I am approaching strategies and systems and techniques and tactics and tips and rules and psychology. I am the psychology of a mason, and you learn early. Don't crush your fingers with bricks. Don't do that. Well, you'll see why. Yeah, nice. Yeah. And if you're in the machine shop, you don't just grab pieces of metal, because hot metal looks just like cold metal. And Charlie Jones taught me that one. He says, hey, bring me that file, which a minute before he had to red hot, and when it had cooled off just enough to look like cold metal, he said, hey, go bring me that file. Ah, thank you, Charlie. Thank you. Approach metal with caution. Sense your environment, you know.